All right, all right. Compound Nation, what's going on?
Hello, hello.
Hey, Mike, how's your work-life balance these days?
It's very balanced. Incredibly
Is it?
balanced.
Are you doing good in that area?
Yeah, it's so good that the kids missed the bus today. Robin calls me every morning to make sure I'm up.
Yeah.
I woke up today 8:10. Holy shit! I slept till 8:10. That's balance.
So what did you have to do?
I drove the kids to school. No big deal.
Did she threaten to like leave you, or was she just like
Where's
no
she
big deal,
going?
get them to school?
No, it's all
Man.
good.
My work-life balance, I got to tell you, it's not going well. All right, what are we doing here? All right, so we got a new show.
It's called What Are Your Thoughts?
What are your thoughts? There's a lot for us to get to. First, let's talk about our sponsor, Liftoff.
What's Liftoff? Who's Liftoff? It's us.
Yeah, this is how we help people who don't necessarily meet the traditional wealth management firm minimum of $1 million. Or needs. Not everyone needs full-blown hand-to-hand combat financial planning and wealth management. Some people just need to set some goals and then invest toward those goals. A little bit of tax loss harvesting here and there. Like some people,
planning, a little bit of advice.
That's right. So we do that, and you could check out liftoffinvest.com, and we have great portfolios on there. I have my own money on there. Michael has his own money on there, and lots and lots of clients. Yep. All right.
Crew.
So make sure you check out Liftoff Invest. If you love the show and you want to invest alongside of us, easiest way to do it. Takes like 5 minutes. Okay. Bank earnings kick off earnings season this week. Starting, I think Friday we get.
Oh, look at that.
Look at that. Beautiful. So we get Wells Fargo and Bank of America and JP Morgan and Citigroup and BlackRock. It's a lot going. It's a lot going on. I thought some of those were next week. I guess they're all in one day at this point.
What are you most looking forward to, Josh?
They
Who do
come
you like
out
hearing from.
Yeah, they come. Well, I own JP Morgan Chase. That's the only one of that group that I'm a shareholder in outside of index funds. And I guess I'll be curious to hear what the reserves situation looks like, how much they're putting aside for losses, credit losses. And that number has been like a yo-yo since the pandemic era began. And it's probably impossible to get perfectly right. And some banks go a little bit overboard and put a little bit too much in the cookie jar. But the good news is when those losses don't materialize, they don't have to – all of that reserve money that's going to come back drops right to the bottom line. That's how you get earnings surprises. And it doesn't appear that the worst-case scenarios a lot of these banks might have been factoring in circa last summer have materialized. So it'll be interesting to see if that is a source of outsized profit growth.
I am looking forward to hearing from Jamie Dimon specifically, who has been talking about a storm on the horizon. The winds are picking up. I'm curious to hear what he has to say, if he's seen any deterioration in credit quality. And I don't just mean what he anticipates. What has he actually seen?
He gave an interview to Fox News and mentioned 50-50 chance the Fed may have to end up going over 6% before this whole thing is over. I think that's the first time I've heard him say anything like that.
That's aggressive.
Yeah. But he said 50-50, so
Okay.
flip a coin. All right, we have an article from the Wall Street Journal with some really great charts. This is called Bank Earnings to Put U.S. Economy Under the Microscope. It is a good read-through to the economy, or at least you're hearing it from the horse's mouth. These are the companies that are most involved on a daily basis with businesses and consumers. Let's do change in loan balances from a year earlier at FDI-insured banks. So this is registering the 12-month change. So right now, loan balances are up 10% over the prior 12-month period, which looks like we are at a post-pandemic high, which would make sense considering how much money is out there and available. So I think that really doesn't tell you that there's any kind of major economic slowdown at the moment. Do you think I'm reading that right?
Yeah, I'm looking at this, trying to find out what's bearish here, but it seems pretty straightforward.
It's pretty straightforward. It's probably concurrent with condition. Like it's probably a coincident indicator. Let's do U.S. mortgage originations. Some of this is actual, and then some of this is projected. This is a big fall off. Mortgage originations have been, it looks like, cut in half from 21 into 22, which I suppose would make sense given what interest rates have done, and you just don't see as much interest on the part of home buyers to keep doing what they were doing last year. And obviously, that's a big source of profits. So that backing off is going to leave a mark. Unrealized gains and losses on investment securities by FDIC insured banks. These are like the investments that the banks themselves hold. This looks notable. What do you think this is indicating?
Well, it's rising interest rates. It's pretty. That also is pretty straightforward.
Yeah, banks have stowed tons of excess cash in securities, which have been racking up billions of dollars in unrealized losses because of swooning markets. JP Morgan took a loss of almost $1 billion from selling treasuries and mortgage-backed securities last quarter. So we'll see what that ends up looking.
I don't expect
like
any of those companies to be forced sellers. So those should go to zero. The losses.
All right, the big banks all have investment banking businesses, M&A specifically. Let's take a look at that. This looks just like the mortgage chart.
Not as bad as I thought.
I don't know,
because there was no IPO activity, but M&A was okay, better than okay. Matter of fact, in 2021 we all got drunk, right? Like every chart looks like this to some extent. So if you take out 21, we're basically where we were. Not so terrible.
Okay, let's go to the KBW NASDAQ Bank Index, which includes the largest banks. You can see that last year it underperformed the S&P 500, which I was surprised by because you finally got a loan rate. Oh, you finally got an interest rate.
Hang on a minute. So XLF outperformed the S&P. So what's in here that's bringing it down? Is it regional banks? Like what?
So here's what you have to understand. XLF has BlackRock, has insurance
Berkshire,
companies.
yeah.
Those are all making record highs.
Right.
If you just straight up look at the KBW, the ETF for this is KBE. I think over the last 90 days it's up 2%, and the XLF is up 15%. Sean put that together for me for halftime today. So the banks have really lagged. Not all financials, but banks specifically.
Yeah, so that's what it is. So I'm looking right now. So regional banks are 45% of this. That's I guess that's what it is. I didn't know regional banks had such a bad year though.
All right, let's go to the XLF versus the SPY on a shorter term time frame.
What is this? 6 months? 3 months? 3 months.
This looks like it's going into
I'm
October,
sorry.
but
Yeah.
But you've got relative strength. You've got outperformance. Let's go to the next one. This is just, I don't know how much meaning there is here, but this is banks versus the 2-year Treasury rate. It's not consistent at all that a higher 2-year necessarily leads to bank stock prices going up. It doesn't quite work out 1-to-1. You know what I mean?
Yeah, and I think that what really matters is the slope of the curve more than just the absolute level, right?
Course,
if there's a steep,
it's all spreads.
Yeah, so they should do well when curves are steep, and obviously curves are inverted, which we're going to talk about. Let's look at this chart. So FDIC put together a report about this. Let's look at quarterly net income. So if you knew nothing, and you could say, okay, banks are at the epicenter of the economy, right? They are like the lifeblood of consumers and corporations and loans and mortgages and all that sort of stuff. Look at the net operating income. It's basically near all-time highs.
Yeah. In other words, I can see 2008 and 2009 on this chart. Show me where you're seeing any sort of version of that, at least so far, right? Like right now is the opposite of that. Although those navy blue realized securities gains losses, those are, I guess, predominantly sales of bonds. I guess that's starting to show something. But net operating income has not missed a beat.
Well,
it's
next
really
chart, please.
Remarkable.
So if you look at net interest income, again, it's basically, there's not a gigantic change. So you would think that it's so correlated to the level of interest rates. Well, again, it's more to do with the shape of the curve than the absolute levels itself. But the FDIC, here's what they said. Overall, key banking industry metrics remain favorable at this time. Loan growth continued, net interest income grew, and asset quality measures remain favorable despite a rise in early delinquencies. Further, the industry remains well capitalized and highly liquid. However, the banking industry continues to face downside risks resulting from economic uncertainties, inflationary pressures, rising interest rates, and geopolitical concerns. So we'll see. We'll hear from the banks in a couple of days.
Right. And all those risks will always be the case.
Of course.
Hey, but the banks are laying people off, and more specifically the Wall Street banks. And for some reason, it seems like every day there's a new headline about Goldman layoffs, but it's all the same layoffs. I think there's a component of the readership of newspapers that just like to read about people that work at Goldman Sachs losing their jobs. It's really the only thing I can think of why they keep.
Yeah, I think there's some layover from the GFC that it's probably
There's Schadenfreude.
Exactly. It's the most prestigious investment bank amongst people that don't really know anything about investment banks.
Like if Bank of New York Mellon is like we're laying off 4,000 people, it might be one day's worth of headlines. This is a daily headline, and it's the same layoffs.
Well, it's the vampire squid.
So they're hating.
Right, it's a vampire squid. That's.
And then Goldman, I think rightfully, if you're going to fire, one day it was 3,600 people, the next day they said 8,000 people, whatever it is. If you're going to do that, maybe it's good to not also give away free coffee. Like everyone's got to share a little bit of the situation. So this is in the New York Post. The Post loves this shit. A coffee barista set up a table outside Goldman Sachs this week. Claims his colleagues got an earful from the mega bank's caffeine-starved bankers. Okay, let's stop. Nobody working at Goldman Sachs is starving. And then they got a quote from somebody, not that works at Goldman, but somebody paraphrasing. They took that shit away. They took our coffee away. All right. Can you maybe relax? What is the average income of a Goldman Sachs employee? $650,000? Like, what are we even talking?
4 million cups of coffee a year.
It's 4 million cups of coffee. All right. So they're giving away less coffee as they fire people. Can you live with that? Like, are you going to be okay?
I mean, that's a reflection of the Post more than it is,
Yeah. All right. Well, they ran with this. Listen, here's what every Wall Street bank has in common and what every economic cycle has in common. They all hire too many people when the going is good because they have to throw bodies at all the demand for M&A, lending, credit, trading, banking. Like they all do it. And then that doesn't last forever. And there's a downside to that. And in a normal year, they're culling underperformers. And in a complete wipeout of capital markets business, which is what we just saw, don't be surprised. You hired 10,000 people, maybe you only needed 6,000 in real life. And that's just the nature of Wall Street. It is highly pro-cyclical in the way that it hires and fires. And I think everybody needs to come to terms with that. All right, what do you got next?
Let's start with a chart. I want to talk about the power of dividends, Josh. Let's look at this chart. We're looking at the market cap. On the top is Open Door Technologies, which was a SPAC that peaked at a valuation of $20.5 billion. It's now down to 700 some odd million. Carvana got as high as...
Hold on. Open Door is the iBuying?
Yes.
Okay.
Carvana peaked at a market cap of over $31 billion. It is now down to $460 million.
That's incredible.
Incredible. Bird's Scooter, the scooter company, which I'm a fan of.
Yeah, me too.
The product, not necessarily the stock, got as high as $2.5 billion. It's now down to 67 million. 67 million.
Do you remember riding those Bird scooters around in Austin or Nashville or wherever we were?
Every city I go to.
I love it. I can't wait to break my neck on one of those things.
Same.
That's definitely going to happen.
All right. So what these three companies have in common is, of course, gigantic losses, all 95+%. But they don't pay dividends. And so while dividends might not, while the strategy goes in and out of favor, there is something very powerful about companies that can raise their dividends year after year after year. So I want to piggyback on the shoulders of Quarter, which is a company that we've invested in. We talk about it all the time. Just full disclosure there. They did a thread on this. And so
on companies that raise their dividend every year.
Yeah, so I just want to talk about this. All right, let's look at Sherwin-Williams. Sherwin-Williams is, of course, the paint company. That's 43 consecutive years. What dividends can do psychologically should not be understated. Are they the most efficient investment in terms of, yes, the company gets taxed and then you get taxed? All right, fine. Be that as it may. Right. Be that as it may. In an economic downturn, when asset prices are turning down, there is a psychological component that should not be discounted, that that Sherwin-Williams is going to pay you a dividend, considering that they've done it for 43 consecutive years. I'm sorry. They've raised their dividend for 43 consecutive years.
Not just paid, paid more every year.
This one is a great illustration. Digital Realty, I'm not super familiar with this company, but John, next chart, please. They've got a 3.8% dividend yield.
It's like a REIT for servers and cloud computers.
Okay. So they've got a 3.8% dividend yield, which is compounded at
Currently.
10.5% over the last 17 something years. And in the chart, it says it's committed to a secure and growing dividend, 17 consecutive years of dividend increases. And again, the payout ratio you can see on the bottom, that is very steady. They're not doing anything funky to generate the dividend. They're not borrowing money to pay it out. It's just from operating profits. And then lastly, realty income. It shows that dividends matter to long-term investment returns. Of course, we know this. It's just really mind-boggling when you look at this. On top is the S&P 500 with and without dividends. And on the bottom is realty income from 1994 with and without dividends. Those are gigantic gaps. So I think that there's a lot to be said about dividends as an investing strategy.
I think they kind of are getting rediscovered right now.
Absolutely.
Dividend stocks as a strategy, as a style rather, were down like that. Not asset class, but like, you know how you break the market's returns down into different strategies? The dividend focused strategy, which I don't think specifically is dividend growth. I think it's more just like screening for companies with dividends, was only down 7% last year.
Dividend growth is a subsector, but you're right. It is definitely back in vogue as the investor class shifts from growth to value, for sure.
John D. Rockefeller quote, do you know it? About dividends? He said this. He said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." So,
I love it.
He probably meant it.
I love it. I mean, I don't own a lot of
people used to get dividend checks in the mail back in the day.
Feels good.
Like it didn't get deposited into your brokerage account. You would receive a dividend.
It feels good.
I like reinvesting dividends, and I've always been somebody that likes to be able to measure the degree of success that I'm having in an investment, and you don't get that from the stock price every year. But like, at least if you could be like, oh, and by the way, not to make this into a commercial for Liftoff, but I showed you this yesterday. My favorite thing that Liftoff sends out to us and to our clients at the end of every week, here's how many dividends you got, like in dollars, or a summation over a quarter or whatever. It's just nice to know that there's money coming in.
Do you quote dividends in percent or in dollars?
I think it's in dollars in the emails. Is that what you're asking me? No, it'll say X thousands of dollars you got in dividends, and that's cool.
No, it's great.
Because even if it wasn't a good quarter or a good 6 months or whatever for stocks, looking at the accumulation of dividends that you've been paid is dope.
Yeah.
Like, I don't think anybody would argue with that.
Now there are obviously a subset of quant nerds that would say that dividend is value and drag and it's a suboptimal. Fine, forget all that.
Who the fuck listens to that?
On a human basis, it's good stuff.
It's right. It's affirming. It's like an ongoing update that you're getting, showing you that there's some progress being made besides the price of the investments themselves. Like, just like something is happening here. I agree with you. It's
and last thing,
underemphasized.
If the company's raised its dividends for 43 consecutive years, guess what's not happening? It's not going down 95%.
I don't think so. Actually, it'd be interesting, like, how many dividend aristocrats that are raising their dividends every year for 25 years have like become horrible stocks. I'm sure they exist.
Oh, of course. I really hope that Lehman was not a dividend aristocrat.
It might have been. not for long. All right. This is something that you and I don't get into a lot. We've been talking a lot about the disconnect between WTI crude and the energy stocks. And the energy stocks seem to be levitating while the price of crude has fallen.
Yeah.
But markets are forward-looking. And there's a really big story that started in the middle of November with the civil unrest in Beijing, and just the outcry over how much longer can we live in this COVID cocoon. And it ended up flipping the government, and they are dismantling that whole apparatus of keeping people home and closing down factories. They're basically going to make a run for it out of this COVID thing and reopen the country, like really do it. And if you ask, like, why would crude get back to the highs? Well, this would be a reason for crude to get back to the highs. Everything running at full tilt again. And maybe that's what the energy stocks are anticipating. So I want to, and then there's another parallel story where the Biden administration has been talking about replacing the crude in the Strategic Petroleum Reserve. They were sellers at 110. And they said that they would buy it back at 75, and they didn't. And then it got down to 70, and they still didn't. So first, it's a great trade, which everyone screamed at Biden. How could you, blah, blah, blah. Well, turns out not a bad move.
Is he a Fibonacci guy?
From what I hear, he trades exclusively Fibonacci.
Yeah. No, retracement
this is from Peter Bookvar. Putting aside what the Strategic Petroleum Reserve has now become, an oil price manipulator rather than used for legitimate replacement of disrupted deliveries of barrels, Biden Capital Management has a pretty good trade on. They started shorting oil at about 105, 110 in late March 2022 and even pressed all the way down to current levels. As they have now stopped on the short side, the question is when to cover. So they stopped selling. In December, the Department of Energy said they wanted to buy 3 million barrels for delivery to the SPR next month with hopes to make that purchase at around 70. Well, over the weekend, the DOE said no to the offer of barrels by the oil companies without stating why. If it was a price thing, the DOE better reevaluate that criteria with China now just about fully open. Like if you're going to do it, you probably want to do it right here and now. And then let me just wrap this up. By the way, the SPR's current inventory is the smallest level it's been since 1983. Thanks, John. This is the SPR inventory in barrels. Look how far this chart goes back. This is the least amount of crude oil by barrels that we've had in 40 years. So this is the rest of Peter's comment. I can't emphasize enough my belief that the China reopening is huge news, not being fully appreciated with its impact, not just on China, but on the world. Their reopening should be viewed through the same lens as the reopening in the U.S., Europe, and everywhere else. Unleashing of consumer behavior and spending. China's population of 1.4 billion is 17% of the world. And after essentially being locked up for 3 years, they are now liberated. Somebody showed me a chart of Wynn Resorts going vertical. That Wynn Resorts is a China reopening beneficiary.
It's funny you mentioned that. I was looking at the casino stocks today, and they are on fire.
Yeah, well, this is the reason. Yeah. The Chinese, after 3 years, are coming out. And they love that.
Remember Macau was huge in the headlines for a bunch of years.
So then this got me thinking, what's up with the strength in the industrials? Oh, they sniffed this out. They know this is coming. So the China reopening story is an underappreciated story just because we cover China through this geopolitical competition lens here in the United States, but we don't really anymore. We used to. We don't really talk as much about the economic impact. And yeah, the reopening of U.S., think about what that did to the global economy and to U.S. stocks. The reopening of Europe, they're now doing that. They're in the throes of it.
Is that good or bad? Is that good or bad for upward price pressure?
It would make me bullish certain commodities and definitely bullish on oil. Just purely on demand.
Hey,
and then probably casinos.
With all that money that the government made on that oil trade, do you think they put that into industrials? Would that explain the strength in industrial stocks? I mean, the money has to go somewhere. Am I right?
Well, what money? All the money that they got from selling oil out of the SPR?
Yeah, right. It's got to go somewhere.
Ostensibly, it's going to be used to buy back oil. No,
I think it went to Caterpillar. Let's keep. Anything else, Josh?
What are your thoughts?
I don't have a ton to add. You just laid it out. This is not my area of my domain.
Well done. I'm glad you prepped for that.
Listen, you spoke for 7 minutes straight. It's enough. I don't have any thoughts. I gave you the mic.
All right,
well done. All right, let's talk about Kim Harvey and his inverted yield curve, which is an indicator that I think he brought to the forefront, brought to the newspapers. Cam
Harvey discovered the correlation between an inverted yield curve and a subsequent recession back in the 1980s.
It's got a great track record. 8 for 8.
Yeah.
No false signals. And credit to him, he said, I have reasons to believe, however, that it is flashing a false signal. Now, I just want to spend a minute and congratulate the intellectual flexibility to not be married to his own indicator. How rare is it that you see somebody that's something imagine for example, if I don't know, Cliff Astos was like, hey, the growth value spread is ludicrous, but I actually think it doesn't matter this time. It's very.
I would have gone with
maybe that's not a great example, but you know what I mean.
Dick Arms and the Arms oscillator, people that have shit named after them.
McClellan, if he said,
McClellan oscillator,
disregard this time, that's good for him. Yeah. Good for him. So why might it not be valid this time, and why should there be reasons?
Well, wait, before you get into it, didn't Jeff DeGraff come on our show, the Compound and Friends, a couple weeks ago, and say that it's lost its signal because of how much the Fed is now over communicating in advance, which obviates the need to even look at a yield curve when they're basically laying out what they're going to do? He said something like that.
Absolutely.
Okay. And then we've also had people say the absolute level of rates matters. And with interest rates at zero, what yield curve are you looking at?
Well, and also, Cam's model was linked to inflation-adjusted yields. And he said the fact that inflation expectations are inverted, meaning traders see price pressures easing through time, and I'm quoting the article, that also eases odds for a recession. So Harvey said, when you put this all together, it suggests we could dodge the bullet. If a recession arrives, it will be mild. So again, labor market strength, the fact that the Fed is so communicative, all of that sort of stuff. Credit to him. That's something you don't see every day.
So he says, when you put this all together, it suggests we could dodge the bullet, avoiding the hard. Yeah, all right. So I like that he's willing to give us like, yes, my shit is 8 for 8, but here's why it might not matter this time.
Not being a slave to the model is what I'm trying to say. Good for him.
Yeah. All right. Let's talk about Silvergate. So this is really interesting to me. This is a good old-fashioned bank run. It actually appears, knowing very little about banking, it appears that they've been doing the right thing all this time. And I wouldn't say that they're being rewarded for it, but the stock is not zero and nobody's in handcuffs. So I listened to a really great podcast that the Wall Street Journal puts out every day, and they had their reporter, David Benoit, who's been covering Silvergate and crypto, talking about what's going on. Let's start with, this is a stock. John, do we have this? This was a $222 stock at the height of crypto that is now $11.
Well, how about this, Josh? To add some color to that, it was a $6 billion stock.
Not anymore.
Under $400 million.
Yeah, no shit it is.
Whoa.
All right. Let's do this total return chart.
Yeah, it's not great.
All right, so no one's winning, but depositors legitimately pulled out, like, they were at $18 billion in assets on deposit. This is a regular bank, and let me say what I mean. They're the bank of crypto, but they're not a crypto bank. They don't hold any Bitcoin. They don't hold any ETH. That's not what this is. They're holding cash deposits from corporations that happen to operate in crypto. Does everybody understand that distinction? But they're a traditional bank. They work with regulators. They file all the SEC stuff. Like, they just happen to get their hands dirty working with these lowlives. They're not one of them. So what's really interesting here is they knew to play it safe and not like lend all this money out to all these crypto projects. They kept it in treasuries. So yes, it hurts. You have to. They went from 18 billion to, I think they have 3.8 billion left on deposit.
But also a lot of the deposits go into short-term bonds, and so they got wrecked.
Yeah, it's a wreck. No, dude, it's all bad as they say.
Well, actually, it might be even worse. It might be even worse. Finish your thought.
But the point is, they're doing their job. They weren't like, oh shit, we don't have the money, or oh, there's an IOU that the CEO signed, or there's no stable coin. They were just like, all right, shit, I guess we got to liquidate $12 billion worth of treasuries and give these companies their money back, but they're doing it. And I think, like, even if this goes to zero, I have no idea. The guy deserves some credit. He's not a crypto kid. He was a real estate banker who fell in love with crypto in 2013.
Well, interesting you should mention the real estate angle, Josh, because this tweet came about just before we started the show, and I thought this was like really a head scratcher. So interesting from Kate Barry about implications of Silvergate tapping the Federal Home Loan Bank for $4.3 billion. The Federal Home Loan Bank is designed to support housing, but now propping up crypto banks. What is this?
I think they must offer mortgages.
Okay, because I was going to say, is Silvergate in the mortgage business as well?
Well, they could tap the Federal Home Loan Bank if there's some sort of housing activity. But my understanding is that this was a business that was 100% real estate and then started doing some banking for local crypto companies in California, and then went all the way crypto and got rid of their accounts that were real estate related. That was my understanding.
Okay. I don't know
based on the reporting at the Journal.
I don't know how any of this works, but this is an interesting revelation that I'm sure we're going to learn more about in the coming weeks.
Yeah, no, it's an unfolding story, and by no means do I want anything to do with the stock, but I just thought it was like nice to hear that there's one company in this fucked up ecosystem that's actually doing what they said they would do, and they held these deposits in accessible cash and or easily liquidated securities, and therefore, if you were a crypto company that banked with them and you needed your cash back, you could get it.
Yeah,
I think that's. I feel like that's good.
One of the analysts covering this made the same point. Like, listen, good for you guys. Like, what other bank can handle 2/3 of the deposits leaving and still be okay?
Well, it's not even that. No other bank is doing this, which is why there's so much shadow crypto lending, because there aren't 10 Silvergates, and most banks, similar to cannabis, the banks just don't want anything to do with this because it's unclear what the regulations are going to be from day to day. And how aggressively, so Silvergate, this is not great. They had a quote on their homepage up until like a couple of weeks ago. The quote is, I think, you could divide the crypto history into two things, like one thing before Silvergate and one thing after Silvergate. And that quote was from none other than Sam Bankman-Fried. And they had that on their homepage. So they clearly are in the mess, but I'm just saying it doesn't look like they were playing games with tokens and stable coins.
They were the bank for FTX, as they were the bank for everybody.
Oh, no doubt. They were bank for everybody. We just learned about some new people who were backing FTX as venture investors. We just learned Paul Tudor Jones was in there too, and Bob Kraft.
Was Dan Loeb in there as well?
I don't want to say that out loud without knowing for sure.
Okay.
I only read the headline. Anyway, all right. What are we doing next? I think you're up.
All right. Let's talk about. Hold on one sec, because I have this article right here. Let's talk about. I want to talk about some EPS growth. Yep, Dan Loeb was in here as well. Okay, I wanted to just clarify that. Yep, Peter Thiel as well. All right, whatever. A lot of people were. All right. So Economic tweeted this thread from Credit Suisse. There's some really good stuff in here. Let's look at market returns. First chart, please, John. All right, so we're looking at a very traditional style box. On the left-hand side, you're looking at 2022 price returns. But what I want to point your attention to is the attribution table on the right-hand side. And the interesting thing is the earnings per share growth was positive across the board, with small value having the highest earning per share growth. Still got whacked, but that certainly offset a lot of the declines. Next chart, please. This comes from Ned Davis, and the important thing, I know there's a lot of charts here. The thing that I want you to focus on is the black line, which shows, the red line shows the market cap, the median price to earnings ratio for growth stocks, which is, I think, 113% above its long-term average. Whereas value stocks are still 12% below their median price to earnings ratio. Let's keep it moving. And Josh, you'll jump in when I'm done in a sec. All right, so this is showing, again, 2022 returns, the stock distribution S&P 500 based on, what does that say? Based on the distribution returns. So you could see a lot of stocks got really killed. 119 stocks fell more than 30%, whereas only 30 stocks grew by more than 30%. Again, we know that. But look at the EPS growth. I'm sorry, last chart. Again, skewed, John, last chart, please. Skewed positive. So the market front ran what might or might not happen with earnings in 2023.
That is interesting. What's this scatter plot?
Okay, so which brings us to, so how important are rising earnings per share to the stock market?
This looks all over the map.
Not at all. Not at all. Now, over, more than 12-month periods, sure, it matters. But over 12-month periods, which is basically where we live, it doesn't matter. And the next chart really breaks it down wonderfully.
Sorry, wait. Can you go back to that real quick?
Yes.
So the top left corner, the top left quartile is years in which stock performance was up, but earnings growth was down.
Yeah, and it's all tons
of years all over the map.
And the next one breaks it down even better. So this is from No More Parties on Twitter, showing the S&P 500 has been higher despite lower earnings, 11 times out of 17 since 1955. So how could this be? Well, the market is forward-looking. And if you look at the dates, you'll see that the prior year, the next year was not so good. So the market anticipates earnings falling and vice versa.
Right. So stock prices may fall ahead of earnings falling and then start rising in the year in which they already are falling.
That's exactly right.
Because they had already prepared for that.
That's exactly right.
And
so
now they're looking at the climb out already.
So if the S&P falls 20% in 2022 or 18% or whatever it did, and the Nasdaq falls 30%, well, yeah, you could see negative earnings this year as the market anticipated that with rebounding stock prices. That's not abnormal at all. In fact, that's what usually happens.
That happens actually all the time. That's really, you know what? I know we're doing a presentation for our clients in a couple of days. I hope that you guys are going to hit on that point, because one of the things that like you just keep hearing over and over again, everyone says earnings are going to be down. Mm-hmm. Like, why would we be invested in stocks? Everyone says. So I hope we hit that hard with clients. I'm sure you guys will do a great job with that. All right. We're going to make the case now. You going to pitch me a stock?
I'm going to pitch you a stock that I own.
Okay. I love it.
But before we get to the stock I'm going to pitch, let's look at a chart.
Oh, wait. You missed this.
What did I miss?
Fed pause.
No. This is where I'm going.
Oh, it's part of this?
This is part of it.
My bad. Go.
So before I make the case for Zillow, I want to look at this chart from Warren Pies. And this is what happens during Fed pauses. So when the Fed is no longer raising rates between meetings. 2000, of course, as you can see, was the exception. But every other time, look what happens when the Fed pauses. And we're close.
So wait a minute. So why? All right. So the Fed when is the Fed pausing?
So for example,
at the zero line, the zero line is the Fed's last hike.
So what the market is expecting is a 25 basis point increase in February and another 25 basis point increase in March.
Okay.
So then that would be the pause if they don't do another one in the following meeting, which I think is May.
Okay. And then, all right, so what happens? Stocks start to rally immediately.
Yep.
Huh. All right. And we think 25 basis points, no-brainer for February. There's another one in late March. And April, there is no meeting. It's possible that we come back in May to the next FOMC, and they are on pause.
78% chance.
Can I just start front-running that right now?
Well, maybe the market's already doing it.
I'm sure it is. What 70 what percent chance?
78%. A month ago, it was 40%.
78% chance of what?
78% chance of a 25 basis point rate hike and
February?
And a 22% chance of 50. A month ago, those numbers were 41 and 49. So what happened was we got economic data that's supporting the case for the Fed slowing down. So we'll see.
Throw all that out because you're going to get CPI on Thursday, and that could radically change whatever anyone is saying right now.
For sure. Listen, if there was a surprise to the upside, which seems that's not what I would guess, but it's certainly possible, then these numbers are going to get changed dramatically. So you're right. We'll see. All right. So I want to make the case for Zillow, which is I'm going to talk over the charts, John, please. So this is a great example of everything that was wrong with 2021. We all got drunk and now we're hungover and it's not fun. And there's just so many examples of this. So Zillow was the beneficiary of work from home, of the migration from the city to the suburbs, and housing speculation and increased housing prices, and the iBuying thing that was supposed to be hot, which turned out to be not.
Everything that could go wrong went wrong.
Yeah, so they're on the other side of that. But they did get out of the iBuying business completely, which was an absolute unmitigated disaster. And they own that. So next chart shows the difference in performance between Zillow and Opendoor. And I don't know exactly when they shuttered their iBuying. I don't know if it was exactly this time, but I do know that it was sometime in 2022. Summer. So, so you see the discrepancy between Zillow, which shuttered the iBuying business, and Opendoor, which iBuying is its business. So of course it couldn't do that. And then just technically the stock looks fantastic.
Look at this RSI. It's almost overbought.
Come on, it's been a minute. It's been a long time. The stock looks great. They called an upgrade from Bank of America for what it's worth. We'll see. But it's interesting, Josh, because we talk about Well, the housing market is slowing, and yes, it did slow dramatically. There's no doubt about it. I'm not, but the home builder stocks are absolutely ripping. So this is from Bespoke. They're all overbought for the most part. You've got all these home builders in there, and then if you look at like Restoration Hardware, the stock is going ballistic. And let's look at the relative strength of Zillow versus the S&P 500. So clearly it stopped going down. And in fact, it's breaking out not just on an absolute basis, but relative to the overall market. And then finally, the fundamentals have strongly rebounded after the disaster that was the iBuying. And what I'm betting on here is really Rich Barton and his team. That guy is a killer CEO, has a track record of success between Expedia and Glassdoor and Zillow. And this is a premium brand name that I think I'm getting at a discount. So I'm not trading this, even though this name is tradable on the breakout. I plan on holding this for a while.
Dude, I love this pitch. You have absolutely convinced me. I'm going to wait for a dip, but I could see myself in this. I had been in it. I actually lost money in it in early 22. I wasn't in it. I rented it, but it was a shitty trade I did. But I like it, and I agree with you that the brand is really meaningful. Like, this is where people's home searches start. The other thing is, let's not conflate home building with existing home sales. Like, they're two different businesses. Even though you might have home builders list new homes that they're building on Zillow, that's tiny. The amount of new homes we build each year is so small. It's, I don't want to say irrelevant, but it's not Zillow's business. Zillow's business is marketing properties and getting paid by realtors who want to move homes, getting paid by homeowners who are self-listing, and all of the related services from mortgages to title, et cetera. So it's a great hub for activity in real estate. We've just been through a horrific year for real estate, which will not continue forever. There's too much demand. So I think you're going to make money here. I like it. And just a reminder for everybody watching this, we don't give financial advice on YouTube. So please do not start placing trades in stocks that we're talking about. We could change our mind. We could say things that turn out not to have been correct.
Well, that will definitely, I guarantee that will happen.
That's definitely going to happen. So please, we're not your financial advisors, unless we are. But if we're not, then we're then we're not. And please don't place trades based on this. All right. I have a mystery chart. Then we're going to get out of here. I forgot what. I know what I did.
Hit me with your best chart,
Mr. Grayson. Thank you. Take a guess.
This is just, come on. You're not making it. Listen, I give you softballs. What is this nonsense?
Can I give you my hints?
This is terrible.
Why is it
I know what it is. I know what it is.
Oh, but it's terrible. It's three stocks.
I know what it is. It's AMC, GameStop, and Bed and Bath.
Oh, so why don't you go fuck yourself now?
Okay. Credit to me.
Was it so terrible, or was
Credit
it a great mystery
Credit
chart?
to me. No,
Do the reveal.
No, I only recognize this because the purple spikes. I saw that Bed and Bath looked like the VIX.
They all look this. They all have the same chart, but to lessening or greater degrees of volatility. All right. So just really quickly, Bed Bath and Beyond
By the way,
is saying.
credit to me. I didn't even need any hints.
No, you're a genius. And do you want to take anything back?
Stable genius. Do
you want to take anything back?
Nope, I don't.
You don't?
Go on.
So this was a terrible chart, but you're so brilliant that you guessed it?
Go on.
Give me my charts back. AMC, let's start with AMC, is in blue. This is the one that ingeniously created a new share class for some reason, and people were into it, and they both crashed.
Well, the gold mine seems promising.
And they bought a hole in the ground with a liar standing in front of it.
Yeah.
Which one is purple? Bed Bath & Beyond is now openly talking about the possibility of bankruptcy. I saw some pictures of the shelves in their stores. I would say that's a good idea right about now. Even Bye Bye Baby, which was supposed to be their better business, is like down 20% or so.
That's a real business. Like,
they're both real businesses. They're just not good businesses.
Well, Bed and Bath is a real bad business. I mean, not that I know the fundamentals all too well, but like I feel like that's still that's still the brand name for baby gifts. No.
Do you know that Bye Bye Baby was founded by the son of the founder of Bed Bath & Beyond, and then they acquired it?
I did not.
And the shareholders were kind of like, oh, you're buying your son's business? I guess that's cool. It didn't go well. Chart back on. Oh, GameStop, the stock that started it all is in orange. That one's down the least because the memes, I guess. I don't know. Maybe they're not in as much trouble balance sheet wise. I don't know enough to have an opinion on the fundamentals, but down 74% is still really bad considering all of the hype that had gone into this and the effort being made to support the share price. I think it's $16 per share.
I feel bad for all of the people that got sucked into this.
So
you
do
could
I.
say personal responsibility, and I get that, but these people were influenced and all that bad shit. So,
and by definition, like they just didn't know, they didn't understand how fundamentals work really. They just saw a stock price going up and all their friends making money. Yeah. What do you want from people? Like people aren't geniuses. Yeah. You know how many stupid things I get sucked into because I don't know about them?
Yeah.
Like, so I agree with you. I don't take any pleasure at all in the fact that these stocks turned out to be landmines, because it's, in the end, it's still people lost money. All right, that's what we're going to say about that. To wrap up, it's a new year. We're back to our regular schedule. We have 3 shows for you guys this week. Tomorrow, All New Animal Spirits with Michael and Ben, my personal favorite podcast. Thursday afternoon is Portfolio Rescue with Duncan and Ben. Show is picking up a lot of momentum. If you guys want to send questions in for Ben to answer, here you go. askthecompoundshow@gmail.com. And if we use your question on an episode of Portfolio Rescue, we're sending you a free laptop sticker on us. And then Friday, of course, all new Compound and Friends. I want to thank you guys for going absolutely nuts over the JC Peretz episode that we put up last week. 40,000 views and counting. Huge podcast download numbers. You guys love JC. He loves you back. We will have JC and Steve back on at some point later this year. But thank you guys so much for all the feedback. Another hot show coming for you later this week, so look for that. We out.
Bye-bye. Thank you for watching.